All right, Mark, so why shouldn't or why should someone maybe potentially pay off that mortgage? Maybe people are thinking, hey, let's get this mortgage paid off, make my retirement a little easier.
Well, we're saying they shouldn't. That's what we're talking about today is why you
not?
should not. Okay, so number one is, well, you do not have 6 months liquid reserves. You don't have a minimum of 6 months of reserves. When we say pay off early, we mean putting any amount of extra principal towards, it's either refinancing from a 30, a 25, or up to a shorter term, or prepaying that mortgage, putting 50, 100, 75, 25, I don't care, $2 extra to pay it off earlier. That's what we mean by paying off. It can be through a refinance to a shorter term or just adding extra principal to your monthly payment. Number one is an obvious one. We talk about it each and every weekend. You don't have liquid reserves. You don't have a minimum 6 months cash in the bank or somewhere where you can just tap into it if you need. We recommend before you shorten the term, you should have 12 months. But at a minimum, we all need 6 months sitting there. All right, Craig, number two is I'd say it's you're not contributing the max to your qualified retirement plan. Yeah. So you're not, number two is if you're not putting money in your qualified retirement plan, which will be your 401k or it could be an IRA or a Roth IRA, traditional Roth IRA, etc., then you need to not put money into real estate, which is what you're doing whenever you pay down the principal. When you pay down that mortgage, you're investing in real estate, but you have 0% rate of return on those funds that you're prepaying the mortgage on. You just have to do the math. What's the rate of return you can receive on that investment in anything other than prepaying the mortgage? Is it greater than the 2.5% or 3% or 3.5% or 4% that is the effective rate that it's costing you to borrow those funds? And number three is you have too much month at the end of your paycheck. So obviously, folks, if you're already struggling a little bit, you don't have the 6 months put aside, and you're already just struggling. Don't let anyone convince you that to get a quarter or 3/8 lower rate that you're saving money. You're moving backwards, because what are you going to do if you can't make ends meet and you can't make the mortgage payment? Well, you're going to start using credit cards. Those credit cards are going to have an higher interest rate than 4.5%, 5%. So the quarter you're saving in interest isn't a savings if you're moving backwards on your financial plan. Number four is you are not investing in your retirement in a diversified fashion. So understand, it's one thing that you're going to put money into your qualified plan. It's the next thing that you're going to diversify. You're going to have investment assets that are driving you towards your retirement goals that are not specifically that retirement plan that you have through work. So number four is you got a retirement plan. And number five is, if you've got children, this applies to you. Number five is you've not saved for or are not actively saving for your child's education. So these are 5 reasons. Craig, any opinion on any of these? 5 reasons not to get convinced, not to let someone sell you on a lower rate or just the freedom of having credit card debt and no retirement but no mortgage.
Yeah.
It's not freedom.
It's usually, what we find with this a lot, folks, is it becomes a mental block for a lot of people. And I've talked to young folks who don't have a lot of money liquid, they don't have any investments in any other type of investment, yet they're purchasing a home and they want to put 50% down. Or they're putting 20% down and they've got a bonus coming, or they come into some money and they want to put that big chunk toward their mortgage. They get this idea in their mind that this mortgage thing is this bad debt and they've got to get it paid down. Just remember, whether you've got a $1,000 mortgage payment, $1,500, $2,000, $2,500, whatever, most people's mortgage payment is comprised of principal and interest, taxes, and insurance. And only about 25 to 30% of your payment is actually an expense by the time you factor in the tax efficiencies. The rest of it is going to exist regardless whether you have a mortgage or not. You're still going to be paying real estate taxes, you're still going to be paying insurance. And remember, right now when you make your mortgage payment, you're making a principal contribution when you make that payment each month. That's your money that you're just putting back into your pocket when you make the monthly payment. So that's not savings when you're no longer writing that check. It's just a check. You're not moving from one side of your balance sheet to the other, or from your left pocket to your right pocket, as I like to say. So having a paid off mortgage doesn't usually pan out as well as people think from a financial perspective, and you're definitely certainly not liquid, and you're trapped with a bunch of equity into a piece of real estate that may or may not increase or decrease in value. and you certainly would have to go out and pay some kind of fees probably, or go through some type of process to access any of that equity outside of liquidating and selling the home. It's always better to be diversified and liquid, in our opinion, especially with rates as low as they are. Keep this in mind.